Hello friends, welcome to Option Punter YouTube channel. If you remember previously I talked about what is technical analysis and what are the key things you need to know when you are looking at technical analysis. If you remember, there are a few things I mentioned. One was price, volume, and then when you're studying price and volume, you have to look at, for the prices to continue to be in a trend or break down the trend. Then the second thing was about looking at whether the prices are or the stocks or that underlying thing is overbought, oversold, and some other things. So this particular video tutorial, going to focus on the first and the very important aspect of technical analysis, and that is determining the trend. How can you figure out trend? Now, there are hundreds and hundreds of indicators, all right? But what I'm going to share with you is the simplest and the most popular way of determining the trend. And now, it may come across some of you who may already know about the markets. You may think, oh, well, I've heard about this thing a lot of time. Well, you might have heard about this a lot of time, but did you use it to make money? And if you haven't really used it for making money, then I would suggest that look at this tutorial with a fresh perspective and see what is it that you might probably be missing when you were applying this indicator. And if you are completely new, let me tell you this. People will tell you it's simple, it doesn't work, and all sort of nonsense. Just tell them, shut up, let me study this first and let me see whether or not it's going to make me money. So let's get deep dive into it, understand how basically you use moving averages to determine the trend, whether the trend will continue or the trend is going down, or what could be your entry point or exit point using that trend. I want to talk to you about moving averages. I will share with you what is the best way to use those moving averages. How do you build the right kind of moving averages which will give you amazing result. So now once you look at it, you'll find that you have one candle, second, third, fourth, fifth, sixth, seventh, eighth, 9, 10, and so on. Now each of these things will have four prices. The four prices can be, if you look at it, high, low, open, and close. Now, as we are moving from one day to another day, you can create an average price, okay? Now, this average price is an interesting one because what you're doing is you are trying to smoothen this price moving for that particular day and create an average to find out how the prices are. So some people may use only the highs of the day, some people can use low of the day, some people can use only the opening, and some use close price, or depending upon what variation you choose. In fact, you can also choose high plus low plus open plus close divided by 4 to give you the average price of that day. Okay, in most of the cases, if you go around and if you see people using the moving averages into their charts, most of the time it is a closing price. Then now you may choose whether you want a 3-day average, you want a 5-day average, you want 8-day average, or you want 10-day average, or you want bigger. And that's what really is that you see people explaining to you, that I'm using simple moving average for so and so date. So 3 days is naturally showing you, it's a very fast moving average, showing you the average of the last 3 bars. Similarly, if you're using 10, then it is showing you the average of the last 10 bars, right? And the most popular, I'm going to talk about that as well in a minute, are 20, 50, and 200. And I'll come to that in a minute as well. But, while you're using averages, there are actually multiple types of averages. So what do we mean by multiple types of averages? You can take, a simple average or a simple moving average, or you can use exponential moving average, or you can use weighted moving average, or you can choose Hull moving average. There are many types of averages which are available, and the two most popular averages are simple moving average and exponential moving average. So which one should you choose and which one you should not choose, and what are the key differences between simple moving average and exponential moving average? The simple moving average is really just the simple average of those 10 days, while exponential moving average gives weightage to the more current market movements. Okay, so if you want to just normalize it over 10 days period, 20 days periods using a simple, then you call it simple moving average. But In case of 21 days, for example, you want to give more weightage to the recent price action, then you use exponential moving average. Now, when you're looking at the moving averages, um, ideally speaking, you should have three different types of settings: short-term moving average, and then you should have a medium-term moving average, and then you can also have a long-term moving average. Now, why would you have these three different types of moving averages: short term, medium term, and long term? Short term, so that you can see what has been happening in the price action, especially in that shorter period of time. Long term may be really very, very long, and by the time you make a decision, it might be very late. So which is why you may not want to choose just one long-term option. So what are the advantages of a short term versus a longer term? Shorter term helps you to take quick action, and longer terms can help you refine your major entries particularly. So I use long-term averages especially for bigger long-term oversold kind of opportunities where I can benefit from a rapid market move. So when you look at these three types of moving averages, short term, medium term, and long term, the most popular simple moving average for short term is 20. Some people also use 21 moving average. For medium term, many people use 50-day moving average. Now, some people like to go for medium term as 100-day moving average. They think that 50 is also too quick. But in my opinion, you can use 100-day moving average, but make sure that you also use 50, because 50 is used by millions of traders all around the world. And for long-term average, people are using, or most of the traders use 200-day moving average. So these are three different settings that most people are using. One fantastic usage of moving averages is to use the moving averages as your stop loss criteria too. So in case if you've been in a trend and you've been following it and you see the market just keep going up and up and up, and you've been fortunate to get a lot of money out of that particular trade, you may say, okay, I'm going to use 20 or 21-day SMA as my moving average, meaning if the price drops and closes below 21 moving average, I'll say I'm out of that long trade. Similarly, you can choose 200 or 50. Typically, when I follow, I rather go for 2021. I don't really look for 200-day moving average as my stop loss criteria. And the reason for that is simply because by the time it hits 200-day moving average, it's pretty late. Okay. Short term, I use for most for the stopping out, and the long term, I usually define and refine for my entries. Sometime many people also use, or the traders also use, like this may be your short-term moving average. Let's just use another one, another color. This may be your medium-term moving average, and then there may be like, sorry, this may be short-term, this may be medium-term, and this may be more of a long-term. So let's call it short-term, medium-term, and long-term. So some people also define, I mean, this is also a great usage of the moving averages, is that you can choose these areas as an area for entry, where you see all the conversions happening. And once it's crossing through this, you may define and use it as your entry points too. So I'm going to share with you how it looks like when you are looking at a real chart. What you're seeing on my screen now is Thinkorswim. If you look at it here, and if I zoom in, you will see that there are prices, right? So this is for SPY. SPY is the S&P 500 ETF. And here you will notice that there are actually four prices, right? So look at this bar that I'm pointing out here in the red bar, and look at this box. This box will show you open, high, low, and the closing price. The high price for that day was 472.87, and the low price was $464.8. How can we use moving averages to make some trading decisions? So let's say if I use SPY and I go to studies and I look for simple moving average, and let's say I add three simple moving averages: short term, long term, and medium term. So short term, as I mentioned, that most people are using 20-day moving average, and for medium term, all or most traders use 50-day moving average, and for longer term, most of the trader worldwide tend to use 200-day moving average. So I applied these moving average, and you will see, well, I've got three different lines here, correct? Now, the very first observation you will have from this chart is that Every time SPY drops around this blue line, which is 50-day moving average, it tends to bounce. So let's count this here. It has dropped to 50-day moving average one time here, second time here, third, fourth, fifth, sixth, seventh, eighth, and then ninth, and then 10. Almost 10 times it has dropped to that. And if you would have just made one simple trade strategy, that is, you will go long once that underlying stop drops to 50-day moving average, and you decide maybe 100-day moving average or 200-day moving average as your stop loss, you will notice that out of 10 times, actually you will lose only on one time. 9 out of 10 trades would have been profitable. Now that's a pretty significant result for a not like a rocket science based strategy, a very simple strategy on S&P 500, just on 50-day moving average. If you would have decided to go in, out of 10 trades, 9 trades would have been profitable just by following that. So you've got short term, medium term, and long term moving average. But is that it? Can we just simply use it, or can we also modify it? So what I'm going to show you the best way to use a moving average. Okay, so let's go ahead, and for example, let's say I'm going to use Microsoft, and that's where I will show you how we can use this on Microsoft. So how do you figure out whether or not should you be using? Here is one very important thing that you need to understand when you're trading moving average. Each stock exhibits its own character, meaning that the 20, 50, 200, you can't take it just as given for every single stock. Remember, each stock behaves quite differently. And if you are into that particular stock, it's worth the effort to figure out what sort of settings are best suited for that particular stock. Okay, so let's do this for Microsoft. I'm going to remove all these from here, and I'm just going to do here, let's just go ahead, edit studies. I'm removing all of those, and let's begin this trial with 20-day moving average. Now if you see this, you will say that actually it does not really behave according to 20-day moving average, right? You will notice that between this period and let's highlight this period to this period is when actually the 21-day moving average has been working for just about three months. So that might have been good time, but can we play around and see which moving average actually works better? So let's go ahead and edit studies, and maybe then let's go ahead, edit studies, and I will change these settings to maybe, let's say 25. Let's just say 25. And we look at it and we say, does it follow 25 moving average? We'll say, hey, it doesn't really follow even 25 moving average, except for this period when the stock was really trending. Let's see another one. Let's just maybe make it 30 days moving average, and then see if it follows 30-day moving average. Apply and okay. So we see the 30-day moving average, well, not really. It doesn't follow even 30-day moving average. It may or may not be a good example of using moving averages, except for this 4 or 5 months period. Let's change this again, and maybe let's make it say 50-day moving or 40, just one by one as we go through 40-day moving average. And when you come here, we look at 40-day moving average. It doesn't seem to follow 40-day moving average as well, right? So let's go ahead and change this and make it 50-day moving average, and keep looking at it and then see whether it works on 50-day moving average. Now we're getting closer to some sort of exhibit that Microsoft tends to follow. So 50-day moving average, we have some, but we still have some room that it actually tends to dip below that level as well. So let's go ahead, edit studies, maybe change this to say 70-day moving average. So we click 70-day moving average, and then we see now it's trying to make more sense. If you look at here, 70-day moving average, it fits perfectly here. 70-day perfect here. There are some room for error, and again 70-day moving average. So what I've just done and what I've demonstrated to you is that don't just take it as given. If you are being given, or somebody is just telling you that, okay, go ahead with 50-day and 200-day moving average, use this knowledge to see what sort of patterns this follow, because stocks tend to move in a cycle as well. So see what sort of cycle it is following, And if you happen to see a Microsoft, every time it drops to around 70-day moving average, it does tend to move, okay, except unless there were a little bit of period with a little bit of bearishness. So you may say that, okay, 70-day moving average is what probably I will use for my entry. Now, let's use another moving average to define what possibly could be a stop loss. So I go in studies, edit studies, and I will just duplicate it here to find out if I can get another simple moving average that I can use as a stop loss. So now this stop loss, what do you think should be bigger? Setting bigger than 70 or lower than 70? Should be bigger than 70, right? So let's just go ahead and say 90 days, for example. So if I click on 90 days, I will just change this color, 90 days, edit studies, and I change this color so I can see different. Now you will notice that actually it does go to 70 days, but then pulls back to about 90 days, and then it comes in. So maybe I can't remember 90. I will just change this to 100-day moving average, edit studies, and I make it 100. And I say, hey, okay, I can use 100-day moving average as either my entry point or my stop loss point. Most of the time, it is not really dropping. So I could have used 70 days an entry point and really benefit, but between 70 and 100, not so much of the gaps are there. I could have also chosen 100, but if I would have chosen 100, I probably will not get the entries here, right? You see that? 70 days, I would have gotten the entry, and I could have possibly used 100-day moving average as my stop loss. And I will be riding, if I would have taken this entry here at 70, at 242, I will be actually riding even all the way now without being stopped out. Emotions really become the difficult issue when you are trading the stocks, but having a mechanical system can allow you to profit from the markets and stay in the market for longer duration. Now let's see, does this setting work for, let's say, let's choose another one example, Shopee or SE, C Limited. Now if you see SE, it just doesn't follow any either the 70-day or 90 or 100 days, meaning that you just simply can't use that setting for C Limited. So let's play around and see what sort of settings will work for SE. So I change this, edit studies, and I begin with 20 first, 20 days. So when I click on 20 days, I see that it actually does not follow even 20-day simple moving average as well. So let me also try and play around and see if it follows actually 20 exponential moving average. Yeah, I can use that as well versus simple moving average. Just go in and remove this, or rather I can have both and then see which one it is following better. So let's say simple moving average, and I will also add exponential moving average. Okay, moving average exponential, and I will change both to 20 to show you the difference as well on what is happening between these two. Okay, so change this to 20, and let's make this purple color. Do it. Okay, apply, and then all right. So it doesn't follow 20-day either simple moving average or exponential moving average as well. So this is not really working here. So what averages it might follow? So edit studies, let me remove both 20 exponential, and I'll just keep one only, and then let me change this to say 35. Just why 35? Randomly, just to see what settings are working. And I see that 35, well, it tends to not really work even on 35. So Shopee or C Limited may not really be a good stock. Let's just do one more try again first. 50, let's see on 50-day moving average, click OK, and then apply. Well, it seems like 50-day moving average might be working over last 1 year. 50-day moving average, and 100-day is not really providing any support area. So let's change this to 100 to 150. If I change this from 100 to 150, and now I notice that on Shopee or C Limited, you will notice that it looks like 150 days might be working on C Limited, and about 50-day moving average for entry, possible entry on C Limited. So let's just change this also again, make it 60 to see whether 60 qualifies for entry, and 60 does look like. Now, other thing, when you are doing this test and you're looking at back testing to see what kind of moving average settings work for that particular stock, it is also a good idea to expand your time horizon. So that's another way, another secret that you should be looking at to see whether or not it follows that game. Now, if you look at it here, Shopee on 150 seems to follow even over a 2 year period. 2 years period. Okay, it really did not break that level until recently, and when it dropped, it actually dropped very, very hard afterwards. And in fact, on this red line, on around 60 days or 70 days, probably will be also really nice. So I can also change this again, like let's say make it 75 here. So for longer run, we had 150, and for shorter run, we had 75, and it seems like 75 might be working. So what I'm trying to tell you here is through this strategy and understanding this part is that you have multiple averages that you can use for your trading. Okay, you have simple moving average, exponential moving average, Hull moving average, and the weighted moving average. And then each moving average has multiple settings. You should do the individual stock research and see what kind of settings it follows, what kind of cycles it follows. And if you do that, your rewards can be amazing. So this is how you look at moving averages, and you develop an investing approach. Now you can study it more, and don't think that just by studying this 30 minutes video tutorial or short tutorial you'll become an expert on moving average and you will become a millionaire tomorrow. Now this is a right foundation for you to learn. Well, that's some serious sound. Okay, well, this will help you to set up your basis right. And if you study it well, and if you study as I showed you in the tutorial and figure out the short term, medium term, and long term averages for your stocks and define the crossovers for it, you can really take it to the next level. So don't jump into some conclusions. It's the right time to really understand and see what will make a difference in terms of determining the trends for your portfolios, okay, or for your stocks. You can use it to refine your entry. You can also use it to refine your stop loss and so much more. Now, in the next tutorial, I'm going to talk about, how do you know whether this stock or this trend is coming to an end, especially either on the bullish side or the downside. How do you know whether it is already overbought or is oversold? How can you combine the multiple? Just so much, this is really getting exciting. Now, here's the thing, preparing all these videos is a lot of work, and as you would appreciate that there's a lot of time and thinking that goes behind this. So if you're enjoying this and if you want to appreciate, just book the like icon and send us some love. This will help us to send this video. Other people can find it out as well. And that's it. Just hit that like icon on the video. I appreciate that. Thank you. Now, here's your homework for today from this tutorial. And this is an extensive one, so you can't have a shortcut. So this video is choose the top three stocks in your stock holding. It may be from your local market or maybe from the US market. It does not really matter. So choose the three stocks. If you don't have the stocks in your portfolio, choose the three stocks that you would like, and then find out short-term, medium-term, and the long-term trends parameters for that stock and make that comment below. So I would know it. You have actually done some study and you have really reviewed stocks in your portfolio, and you've played around some settings. I will also leave a link to the websites where you can go and play around with the moving averages, and it's all free. You don't need to buy anything, and spend some time, study it well, and then see, did you find something that can make a difference? And it just happened to be a lot of lightning and things which are going on with the place where I'm sitting. But I thought, you have a weekend or whatever time you have it, you can watch this and prepare a good study plan. So with all that, this is your coach Manoj. I look forward to seeing you in the next tutorial. Make sure you do the homework and let me know in the comment section your top three stocks, and for those stocks, your short-term, medium-term, and long-term moving averages. And once again, stay safe, stay healthy. This is Manoj. I look forward to seeing you soon.